As Mark Twain may have once said, history never repeats itself, but it often does rhyme. Now, in practice, most of the time, it seems difficult to impossible to see what is coming around the corner, how current events will play out. But maybe this just means we need to take a larger view of history. As the saying goes, when in doubt, zoom out. When we do that, we can identify certain patterns that happen somewhat predictably. We can get an idea of where things are headed given the current situation. Because what's happening now is not unique in world history. Things very similar have taken place many times before. And that's exactly what we're going to explore in this video. A few things that are happening right now that have happened many times in the past. The interest rate situation, the fiscal situation, debt, inflation, deleveraging, and more. Putting all of these together, we're going to see that the next 4 decades are very likely to look very similar to a reverse of what happened over the last 4 decades and very similar to what happened in the 4 decades preceding that. Essentially, there is a 40-year interest rate cycle that has just peaked and is about to head back the opposite direction. But first, why does this matter? Well, the first reason is that virtually every financial advisor, every economist, every person who manages money or teaches people how to manage money has only been in business during the most recent 40-year cycle. And for the last 40 years, things have been heading very predictably in the exact same direction. But the 40 years that preceded that, before 1980, things were headed in the opposite direction for 4 decades straight, from the 40s to the 80s. There are very few investors left active today who were actively investing prior to 1980. All of the statistics, all of the advice, all the information, all the data that is given out as common advice about how to invest is based off of the last 20 years, 30 years, or 40 years. And now that we are headed in a new direction that is in most part opposite of the last 40 years, it means the traditional advice based on the last 40 years is no longer applicable. And it's possible that it may be the exact opposite of what is needed for the next 4 decades. Basically, if the near future does not look like the near past, it means that what will work in the future will not be the same as what worked in the past. So what is it exactly that has been happening for the last 4 decades straight? Take a look at this chart with me, which starts in 1980 and ends in 2020. This is a chart of the yield on the 10-year US Treasury. The 10-year US Treasury has been the benchmark for interest rates worldwide. So when we talk about what interest rates have done, obviously there are very different interest rates. There's mortgage rates, there's government borrowing rates, there's credit card rates, there's auto loan rates, there's all sorts of different interest rates. But for the most part, they're going to be benchmarked off of the 10-year Treasury. And for the last 40 years, this interest rate has been headed lower and lower and lower. Right around the end of 1980, beginning of 1981 is when interest rates peaked. Now, if you remember your monetary history, this is right around the time when inflation was beat by Volcker, when the Fed was raising rates in order to get a hold of that inflation that happened during the 70s. And right around 1980 is when that finally peaked and started going the opposite direction. So from 1980, for the next 40 years through 2020, interest rates were dropping. Now, everybody remembers recent history, 2020, when interest rates hit 0 across the board. You get a mortgage rate for 2.5% fixed for the next 30 years. That's free money. That's a free put option on the dollar. And so we had a 40-year super cycle there where interest rates were moving from a high to a low. They can't go lower than 0 for the most part, and they couldn't get much higher than where they were in 1980. Now, a slow long-term move down in interest rates is highly stimulative to the economy, because over the long term, what that means is the economy can load up on more and more debt without ever having the burden of servicing that debt. The cost of making the debt payments go significantly higher. If every year, every 5 years, every 10 years, the cost of acquiring new debt is cheaper than it used to be, well, you can get more new debt to pay off the old debt and get a little bit extra, and the cost of paying down that debt stays the same. This means the prices of everything can go higher because you have more purchasing power. And even though you have more purchasing power, it doesn't cost you any extra. You can afford more for a house. You can afford more for assets. Companies can afford more to make acquisitions and research and development and hiring. Yes, it also pushes the price of goods and services higher. But ultimately, from a GDP calculation standpoint and from a taxes standpoint and from the richest standpoint of asset valuations going up, everybody is happy with this arrangement. Everybody other than the poor, obviously, obviously, who don't understand what's going on in the first place. This means that during a time frame like this, where interest rates are moving from a high to a low, you're gonna want to be investing, you're gonna want to be taking on debt, you're gonna want to be buying assets, you're gonna want to be in stocks, you're gonna want to be in bonds, because over the long term, the bond values go up as those interest rates go down. But as we saw in 2020, interest rates bottomed, which means this cycle is now done. But before we look at where we're going from here, we have to see what happened prior to 1980, because that will give us some clues as to where we're headed from here. Like I said before, when in doubt, zoom out. And so starting in 1940, precisely 40 years prior to the peak in interest rates, we see that interest rates were all the way down at about 2%. Obviously in 1940, that was coming off of interest rates from a previous high, as interest rates had been falling before that. In 1940, interest rates bottomed, started moving higher from there for the next 4 decades until they peaked in 1980. So if we have a 40-year cycle where interest rates move higher and then they move lower, and then they move higher again, and then they move lower again, we would expect, if that's true, to see some similarities between what's happening today and what was happening in the early 1940s. So let's take a look at what was going on in the 1940s to see if there's any evidence to that. This chart from linalden.com shows that prior to 1940, it was about 8 to 10 years removed from a generational banking crisis, where non-federal debt as a percent of GDP had started to fall, while federal debt as a percent of GDP had started to significantly rise. Right along with this pattern of history rhyming, we also got our own generational banking crisis in 2008, 2009, where non-federal debt as a percent of GDP peaked and moved lower from there, and where federal debt as a percent of GDP moved higher from there. So the long-term ramifications of a generational banking crisis are turning out to play out exactly like they did in the 40s. Along with that, we are also seeing the debt dynamics play out very similar with federal debt and non-federal debt. But that's not all. If we take a look at the federal deficit, how much the government borrows on top of what it taxes to spend as a percent of GDP skyrocketed during the 1940s. This was obviously to pay for the war, and the difference between that and what's going on today is significant, but maybe not in the way you think. We also saw the total money supply, this blue line, the money supply monetary base as a percent of GDP, rose up into the 40s and then peaked and moved down from there. Similarly, starting after 2008, we saw the monetary base start to increase, and given all metrics, looks like it's actually peaked now and is heading back down. So now let's take a look at the differences and the similarities to federal deficit spending in the 40s versus today, because there are some similarities and there are some differences that actually matter. But first, I'd like to tell you about today's sponsor, OneGold, because in macroeconomic environments like we have today, there's no better way to preserve your purchasing power than to purchase precious metals like gold, silver, and platinum. Now, I first learned about OneGold from you guys. I started getting comments on it on my YouTube videos years ago. I looked into it and realized this is exactly what I'm looking for. The metal is fully allocated and it's physically segregated. It is also fully insured through Lloyd's of London, and it undergoes third-party audits regularly. This is all done to give you a high degree of confidence that the metal they say is there is actually there, and to minimize that counterparty risk. Not only that, but it is stupid simple to use. All you have to do is open up the app or the website and then create an account. You choose the gold or silver or platinum product that you want, and then you purchase it. You keep it in a secure location of your choice. Myself, I always choose Switzerland. I buy small amounts on a very regular basis, and then once that stack gets so large where I feel like I'd rather have it personally than sitting in a vault, you go back to the app and you click redeem. Partnering with their sister company AppMex, you select from any products and they ship it insured to your doorstep. Alternatively, you could just sell it for cash and receive the funds back into your bank account. As you can see, they make it incredibly easy and cost-effective for anybody to get into stacking precious metals, even if you only have a little bit to start off with. I've become great friends with everybody there at OneGold, and they've been kind enough to sponsor the channel as well. And there's a discount code provided for you with the link in the description below that'll get you $5 as a little sign-up bonus for opening up an account. Okay, so we know that there are some similarities and some differences to the fiscal spending, that is government spending situation situation from the 40s compared to now. Number one, when you get into the early 40s, the federal deficit skyrocketed. Remember, the deficit is how much the government has to borrow to fund its spending. So it's spending in excess of taxes. In order to make that borrowing affordable, the Federal Reserve had to do yield curve control and make sure interest rates didn't rise to a point where the government couldn't afford that borrowing. Today, we are nowhere near that amount of borrowing, but we are headed that way quickly. Number one, the US national debt is skyrocketing right now, and it has risen $851 billion in the last month alone. Much of this was to refill the Treasury General account, which is the government's checking account. But the reason for the debt increasing doesn't matter as much as the fact that it is. And the reason why it matters is because of interest rates. Interest rates right now are much higher than they've been in years. In fact, for the 30-year Treasury, we have to go all the way back to 2011 before interest rates were this high. And for the 1 year, we have to go all the way back to December of 2000. So the government has a lot more debt than it's ever had before. And as it pays that debt back, it has to borrow new money in order to pay that off. Problem is, the interest rate on that new debt is much higher than the interest rate on the old debt. This is causing the interest payments on the government's debt to skyrocket at a faster pace than it's ever skyrocketed before. This means that even if the federal government tried to magically stop spending and bring down the deficit and try and balance the budget, every year the interest rate portion would get bigger and they'd have to cut all the other spending. And so even without increasing the other parts of the federal government's budget, the federal government will have to spend more every year just because interest on its debt is getting way more expensive really quickly. The problem is the federal government has these little things called mandatory outlays. This is the amount of money that the federal government has to spend by law. These are on programs like Medicare, Medicaid, Social Security, and more. And due to the age of our population, these costs are set to continue to increase for the foreseeable future. Okay, that all makes sense. Basically, because of interest and because of mandatory spending, the federal government's spending is going to continue to grow. They don't make enough in taxes to pay for that, so they're going to have to borrow even more to pay for that. And because they're borrowing more and increasing the debt along the way, that's like a snake eating itself by the tail. You just have that expense pile just rolling like a snowball down the hill, getting bigger and bigger and bigger with no end in sight. So how is that different than the 1940s? Well, in the 1940s, the US government was spending all that money on the war, which meant when the war stopped, the fiscal deficit stopped also. We don't have the majority of the spending going towards a war right now that could stop at any moment, and then all of that spending freed up. We are in a situation where that deficit will continue to increase and could very soon look like it did in the 40s as a percent of GDP, without any easy way to just stop spending that money. Basically, the situation that we're in is one of high amounts of leverage building up in the system. But one thing that we know about leverage is that it's always followed by a deleveraging. It's a matter of time, not a matter of if. There are three ways that a deleveraging can possibly occur over the next 40 years. The first way a deleveraging can occur is through inflation. Just like happened in the 40s, the Federal Reserve monetized the debt with yield curve control. And most likely this is the route that we're going to go. As the federal government's expenses get too large for them to be able to afford and borrowing expenses get too high, the Federal Reserve will peg interest rates at a low enough rate for the federal government to be able to afford. The only way to do this is for the Fed to buy all that government debt, so the Federal Reserve's balance sheet would balloon once again and become the lender to the United States government. This has been called quantitative easing. It's also called debt monetization, and the mechanism that they use to do these is yield curve control, buying any amount of debt necessary to keep those interest rates as low as they need. Now, obviously, this means that the currency is being devalued because there is a lot more money coming into existence as a result of that extra government spending, and all of that extra supply of money means that the money is less valuable than before. So prices shoot up as a result. As prices shoot up and that money becomes less valuable, you devalue the cost of all the existing debt. So you get a deleveraging, meaning the cost of servicing that debt goes down because you papered over it, you printed it over. So it's paying for your debt through inflation. Even as government interest rates stay low, because of the yield curve control, interest rates across the board for everybody else will shoot higher. This is because if you are a lender, you're not going to want to accept an interest rate that is lower than the rate of inflation, you're going to want to be able to be compensated for that, get paid back at least as much as inflation. And so the government will get free debt in order to deleverage, but everybody else will have a really high cost of borrowing. Going back to our long-term chart here, we can see that that is exactly the direction we are headed, with rates bottoming in 2020 as the cycle bottomed and interest rates heading higher from there. We would then expect this cycle to play out again over the next 40 years as interest rates continue to rise and maybe peak around the same place, somewhere around 15 to 20%. This is not something that happens overnight. This is something that takes a very long time and is volatile along the way. But as you deleverage through inflation, interest rates across the board shoot up as the value of the currency falls. There's a second way this plays out though, and that is through deflation, because the path that we're headed on is one where the government will not be able to afford its total expenses at some point soon. Again, it's a matter of when, not a matter of if. Now, there's a chance, because of things that Powell has said, and if inflation is still high, that the Federal Reserve decides not to do QE, not to do yield curve control, and not to monetize the government's debt. That means the government would be forced to limit its spending, either because it defaults on its debt or it defaults on payments because it can't raise enough through borrowing from the open market or through taxes. In this case, interest rates also move higher because the government defaults. This means risk goes up. This means everybody who owns government debt starts to sell that debt. When debt gets sold, those interest rates go higher. As we have that deflationary death spiral unfold, we have prices collapsing across the board. As prices collapse, you have more and more debt defaults driving interest rates higher and higher, again completing the next 40-year cycle. Overall, the system has much less debt because of all the defaults. Eventually prices stop falling and you get a deleveraging. It's a different path than the inflationary deleveraging, but it is a deleveraging nonetheless. There's a third option for deleveraging, and that is through a massive increase in productive output. This was one of the reasons why the United States was able to deleverage following the 40s. We had a massive workforce that wasn't contributing to productivity, to an increase in wealth, because you had so many men who are off fighting a war, which is by definition destructive to wealth. When all these men returned to work and actually started producing wealth again, obviously there's an increase in productive output. Over that same time frame, we also had a massive increase in women going to work. So not only did the men stop destroying wealth and start creating wealth again, we also had an increase in the total number of people that were available to create wealth because women joined the workforce. The reason why that would be considered a deleveraging is because it just comes down to the cost of servicing the debt that you have. For instance, if you're making $50,000 a year and you get $50,000 worth of debt, you're going to be in a huge hole. It's going to be really hard to pay off. You've leveraged up a lot. But if you spend that $50,000 on something like a trade school or a programming boot camp, and once you finish, you go and get a job for 200 grand, then that $50,000 of debt is no big deal anymore. So you started by levering up, but that increased your productive output. And so now the cost of that debt is much smaller to you. And that's exactly what happens in economies when you have a massive increase in the productive workforce. Now, in the United States, the birth rate has been falling since the 1960s. You need a birth rate of 2.1 children per woman in order to have a population that just sustains itself. In the United States, our birth rate has been below that level since the 70s, but our population has continued to increase over that same amount of time because of immigration alone. So this productive output is somewhat of a wild card. We don't have men, a significant number of men that can return from a massive war to add to our productive workforce. We don't have a significant number of women because basically all women work today. So immigration is the only place that we are getting a productive workforce from, in addition to what we already have. So if we want an increase in productive output, we would have to increase massively our immigration. And time will tell over the next 40 years whether our policies stay consistent with being a place where people want to move to from where they are. Now, obviously the wild card here with productivity is going to be AI. It's very possible that artificial intelligence seeps its way into every industry, every sector of our economy, and that it massively increases the productive output of our entire economy. So that's a wild card that I'm keeping my eye on, although I wouldn't place a lot of money on that bet. Putting it all together, number one, cycles matter. The 4 decades from 1940 through 1980 were characterized by increasing increasing interest rates, deleveraging, and that was very different than the 4 decades from 1980 through 2020. In 2020, rates finally bottomed at 0, and over the last 3 years now have started to head higher in the new 4-decade super cycle, which means the next 40 years will look very different than the last 40 years, and in some ways will look opposite. The fiscal situation is the main thing that is driving this, with deficits that cannot go anywhere but higher. We will deleverage one way or another, either through inflation or deflation, but either way we get the deleveraging, and either way rates go higher. We'll see things that we haven't seen in a long time, like yield curve control, hopefully a massive increase in productive output, debt monetization, and most importantly, a new normal for common sense investing. This is very likely going to look very similar to the way it looked in the 40s, where value investing, active investing, investing for dividends and cash flow, and even investing in high-grade debt comes back instead of just dollar cost averaging into tech stocks, or even worse, passive index funds. And if you're the type of person who is interested in a deep dive on portfolio allocation in a way that you can bulletproof your portfolio and you don't have to worry about the next 40 years, that you're protected against both inflation and deflation, you want to learn how to hedge your portfolio, how to make small bets with very low risk and high payoffs, or you want to learn fundamental analysis and how to find world-class stocks at great prices, make sure you're buying stocks at a discount, I teach all of that and more in my Heresy Financial University. It is a membership program where you get access to the entire training library of material that I've created, and every time I create a new course, you automatically get access to that as well. If you're interested, check that out with the link in the description below. As always, thanks so much for watching. Have a great day.